think of you. So you're saying there is now a new case for investing in gold. What's the number one reason?
Well, the number one reason, look, the gold debate's been going on for decades or centuries, but there are new 21st century reasons. The number one reason is cyber financial warfare. Vladimir Putin has a 6,000 member cyber brigade. These are not criminal gangs. These are Russian military intelligence working day and night to destroy, disrupt, and erase digital assets. You know, I run into billionaires and you say, what do you have? They go, I got stocks and bonds. I say, no, you don't. You have electrons. It's all digital wealth. This can all be wiped out by Putin and Syria, North Korea, Iran, and other countries. Good example, just a few days ago, Bangladesh, $100 million disappeared. It's one of the poorest countries in the world. They had it on deposit at the Federal Reserve Bank of New York, the safest bank in the world, and the money disappeared. So if you don't have some assets, you know, tangible, I recommend gold for 10%, real estate, fine arts, silver. There are other asset classes, but you have to have something in physical or it can all be wiped out. That's a new reason. A bunch of old reasons, but that's one of the new reasons.
One of the older reasons is that the central banks themselves put a lot of stock into gold as well.
Well, that's exactly right. I mean, I asked, why does the United States have 8,000 tons? I think they should have more, by the way. I'm all for that. But U.S. is 8,000 tons.
You're a gold standard guy.
Well, either a gold standard in the strict traditional sense, or maybe just use it as a benchmark. But you know, just take the dollar in isolation. When people say gold's up or gold's down, I don't really think of it that way. I think that you know, a higher dollar price for gold is just a lower dollar. A lower dollar price for gold is just a stronger dollar. So it's kind of inverse to the dollar.
Yet, at the same time, Alex, for most of the first quarter, gold rose along with the dollar.
Right, and we actually charted the two. Thank you, Ken Hoffman and Bloomberg Intelligence, for sending this over. If you take a look at the Bloomberg, this is the dollar versus gold. So the orange line is gold, and the white line is the Bloomberg dollar spot. And those sort of red boxes there kind of highlight when the two tend to move inversely. But as Scarlett pointed out in 2016, sort of in March, it's been a different story, really.
Well, the reason for that is, you know, sometimes I call gold a chameleon. Sometimes it's a commodity. Sometimes it's an investment. Sometimes it's money. I think of it as money. Right now, gold's trading like money. So think of it as a horse race. You got the euro, the yen, the dollar, and gold is one of these horses going around the track. So the dollar and gold are both showing some strength because of a little bit of a flight to quality, and also, but you know, right now with the Fed dovishness, and it's going to lead to a weaker dollar. Dollar's at a 10-year high on the index. I would expect a weaker dollar, stronger euro, stronger yen. But gold should also go up as the dollar weakens.
So in this argument that gold is money and therefore it doesn't need to have yield, it's actually more like cash.
Right.
But it's not liquid in the same way that cash is liquid, in that you can't store gold in an account and withdraw it whenever you want.
Oh, sure you can. Gold's a lot more liquid than cash. I've never seen any difficulty selling gold, buying gold. Yeah, you have to have it in safe storage. You know, use Brinks or you know.
That's a lot of ifs, though. That's a lot.
No, not really. No, you just have a safe, you know, sign on the street. But you know, as long as it's in you know, a certain certified warehouse or vault, it's fine. But no, gold is very liquid. You can sell it in a heartbeat. Sometimes look at the bond market. Look at October 2015, you know, the flash crash in yields. There was no liquidity in the U.S. government bond market. Primary dealers are stuck with inventory that they can't sell off the run, 10-year notes and 30-year bonds. So gold, I've never seen gold not have a bid. It's volatile, but it's very liquid.
So here's what I see, at least in the short term, that gold's issue is that you have India and Chinese demand has just not been as strong as we think. It has not really gone over that 1,000 tons. So that really leaves the onus on Western ETF investors. Yes, they have flooded into gold in the first part of this year, but how much more juice can they really squeeze out of gold and push gold higher?
Well, the problem, the thing you have to understand about China, they're the largest gold producer, so they have 450 tons of indigenous output, so they don't have to import all the gold they want. They are importing enormous amounts of gold. China lies about their gold holdings. You can look at Hong Kong exports and mining output, and it's far greater than what the Chinese government says they have. So there's a lot going on that's not revealed. But China's out to buy another 3,000 tons to reach parity with the U.S. They have about
3,000 tons. That would be like all the swimming pools of gold.
It would be 10% of all the official gold in the world. But see, that's why they don't talk about it. If you were out to buy 3,000 tons, you wouldn't want anyone to know it because the price would go up. The U.S. has 8,000 tons. China has between 4,000 and 5,000 tons. They need another 3,000 tons to have parity. So when the system collapses, they'll have a good seat at the table. Think of it as a poker game. You want a good pile of chips when you sit down at the table.
Yeah, when we talk about gold and liquidity, most ways that people think of gold as being liquid is through ETFs, GLD, for instance. I mean, because they can go in and out of it very, very quickly.
No, you don't want ETFs.
You make a distinction between physical gold and what you call paper gold. Sure.
Paper gold is paper. Now, an ETF is not gold. When you buy an ETF, it's like buying a share of stock on the New York Stock Exchange. So it can be digitally hacked. They shut down the stock exchange. People say that would never happen. New York Stock Exchange was closed for 5 months from July to December 1914. It closed in Hurricane Sandy. It closed after 9/11. It closes every every weekend. It's a share. You have to buy it and sell, but you don't own the gold, and you're not going to get the gold. If you have a COMEX Gold Futures, if all the longs stood for delivery, they would terminate the contract. They would basically cash settle it because they only have about 1% of the gold relative to the open interest. So all these paper gold contracts, they give you price exposure when you don't need it, and they're going to terminate you when you do. When you want it the most, that's when they're going to terminate you, and you're not going to get the gold.
So what is your price target and when?
Well, look, it's going to $10,000, and the reason for that is
$10,000.
That's the implied non-deflationary price of gold. In other words, if you're going to go back to a gold standard or gold reference, what does the price of gold have to be to support world trade, world commerce, and the money supply? So it's 8th grade math. It's not difficult to figure. But the blunder would be if you go to a gold standard at the wrong price, that would be highly deflationary. That's the mistake Churchill made in 1925. So the implied non-deflationary price, low end $10,000, high end if you use M2, global M2 with 100% backing, which I don't recommend, that would be $50,000. But that's where gold will end up when confidence in paper money is lost, which will be in the next crisis.